contingency fund, annual financial statement, revenue deficit, public account. Whenever you watch or read about the union budget, you come across these financial jargons multiple times. Well, today we will take you through these very commonly used terms that will help you understand the budget better this time. Let's take a look. Article 112 of the Constitution requires the government to present to Parliament a statement of estimated receipts and expenditure in respect of every financial year, that is, from April 1 to March 31. This statement is the annual financial statement. It is divided into three parts, namely Consolidated Fund, Contingency Fund, and Public Account. Consolidated Fund is the most important of all government funds. It includes revenues that are received by the government through taxes and expenses in the form of borrowings and loans. Created under Article 266 of the Constitution, this fund is used for all government expenditure. Additionally, no money can be withdrawn from this fund without the Parliament's approval. The contingency fund is used to meet any urgent or unforeseen expenditure. The President approves a particular sum of money that is stored in the contingency fund for emergency uses. The amount withdrawn from contingency fund for any emergency is returned to the fund from the consolidated fund. Public account constitutes those funds that are received on behalf of the Government of India. The funds in public account do not belong to the government and are required to be paid back to the rightful owners that deposited them. In this case, the role of the government is that of a banker. The money under public account is kept for expenditure on specific areas such as road development, primary education, etc. The money under this fund is held by the government in a trust, for instance in provident funds, small savings collections, etc. Fiscal deficit is the difference between the total income of the government and its total expenditure. For instance, the government has earned 1500 crores and has spent 2000 crores. That would amount to a fiscal deficit. This situation occurs when the government spends beyond its means during a financial year. A high fiscal deficit is not necessarily a bad thing. It can be used for the economy if the money spent goes into the creation of productive assets like highways, ports, and airports that boost economic growth. Central plan of the Union Budget is also known as the annual plan. This is a 5-year plan broken down into annual installments. The funding provided to the central plan by the Union government is known as budget support. The extra budgetary resources required for the central plan are provided by public enterprises. The central plan outlay goes to different sectors like agriculture, irrigation and flood control, transport, communications, social services, etc. A direct tax is a tax you directly pay to the authority imposing the tax. For instance, income tax is imposed by the government and you pay it directly to the government. These taxes cannot be transferred to any other entity or person. These are largely taxes on income or wealth. Some of the most common direct taxes are income tax that is levied on both corporations and individuals, banking cash transaction tax, fringe benefit tax, and security transaction tax. Indirect taxes are levied on goods and services and are collected from the consumer by an intermediary, say a retail store. Common types of indirect taxes in India that you come across on a daily basis are GST, VAT, and custom duty.